Welcome back to Alpha Recap. We're wrapping up the market action from the last couple of days and cutting through the headlines. As always, if you have questions, you can reach us at stockalpha.ai. Ready to dive in?
Absolutely. It was a busy session. Markets closed with a lot of headline-driven moves. We'll unpack the three big threads that set the tone. Capacity constraints around AI at Microsoft, delivery and execution chatter at Boeing, and a high-profile social media trial in Los Angeles putting pressure on ad-driven platforms.
Let's start with the Microsoft story because that one felt like a shift. The conversation this quarter was less about raw demand and more about how many GPU slots the company could actually bring online. That's a big operational test ahead of earnings.
Right, the market had been assuming rapid monetization of enterprise AI, but reality hit on the supply side. GPU chips, the servers they go into, the power and cooling upgrades. Those are capital-intensive and slow to scale. So even if customers wanted to pay, Microsoft was being constrained by physical capacity.
It's an important nuance. Demand didn't disappear, it was there, but revenue hinged on whether Microsoft could provision compute. Investors were asking for concrete metrics. How many GPU instances were installed, utilization rates, customer waitlists, and any vendor commitments with suppliers like NVIDIA.
Exactly. Optimists argued that if Microsoft cleared those procurement and data center bottlenecks, they could rapidly monetize AI. Skeptics warned that buying and installing accelerators at scale is expensive and slow, so upside could be delayed into later quarters. It was less a debate about appetite for AI and more about cadence of capital deployment.
And that cadence matters for growth investors. If capacity was the limiter, you could see revenue sitting on the sidelines until the GPU counts moved. So for anyone holding Microsoft, management commentary on installed capacity was the key signal to watch.
Moving to the second big thread, Boeing was under the microscope with the fourth quarter report. The market was rewarding visible execution. Deliveries convert backlog into cash. So the focus was less on lofty forecasts and more on actual delivery momentum.
Delivery counts are the cash engine for aircraft makers. If Boeing delivered more planes, that meant revenue and free cash flow improvement. But ramps come with risk. Supplier readiness and quality control can quickly derail a production push. Investors prefer a clean beat on deliveries with cautious production guidance rather than a miss or an over-aggressive ramp.
So that report was a litmus test for cyclical recovery in aerospace. If Boeing's commentary was conservative, but deliveries beat expectations, cyclical investors would probably increase exposure. If guidance was weak or suppliers were flagged as a problem, it would justify staying defensive.
Third headline, the social media trial that opened in Los Angeles. This one created immediate legal overhang for ad-driven platforms. The channels of impact are fairly straightforward: higher litigation costs, potential advertiser pullback, and reputational effects that could change engagement and ad pricing.
Yes, and the market reaction reflected two competing narratives. One camp thought the financial transmission would be limited. Advertisers wouldn't flee en masse and settlements would be manageable. The other camp feared structural revenue drag if advertisers demanded material safety or liability changes. Until the trial produces clear outcomes, volatility was likely to persist for ad tech names.
All of those macro and sector moves were compounded by a flurry of 8K filings. Pinterest disclosed exit and disposal costs, Fat Brands and Twin Hospitality filed bankruptcy notices, and the Federal Home Loan Bank of Pittsburgh reported a new financial obligation. For small cap and credit-sensitive names, those filings injected event risk that drove sharper moves.
8K filings are the kind of corporate paperwork that often precedes rapid repricing. For credit investors and distressed traders, these were red flags. For equity holders in those companies, the takeaways were immediate. Reassess liquidity, recovery prospects, and downside scenarios.
Let's pull some of the specific numbers into the conversation so listeners have a feel for magnitude. UPS's quarter rekindled a yield and value trade. Shares rose after the report. The company was trading at about a 30% price to earnings discount to the S&P 500 and had a dividend yield of roughly 6%.
That made UPS interesting for income-oriented investors. The math, a healthy dividend yield paired with a material multiple discount, put it back on some buy lists, but the key was dividend sustainability. Income allocators needed to model operating cash flow minus capital spending to ensure coverage.
And there was Tesla, which provided a good example of sentiment diverging from fundamentals. Shares rose even though consensus was pointing to a down quarter. Analysts were looking for fourth quarter earnings per share of 43 cents and revenue of about $24.6 billion versus 73 cents and about $25.7 billion a year earlier.
That set up the classic momentum versus fundamentals debate. Momentum traders were validating the price action as evidence of recovery or margin improvement ahead, while fundamental investors focused on the year-over-year decline in both earnings per share and revenue. That kind of divergence tends to magnify volatility around the next round of guidance and comments from management.
Let's unpack the implications by investor type briefly. For growth and AI investors, Microsoft was the high-impact name. Short-term upside was gated by how fast GPU installs happened, so the near-term playbook was to prioritize management commentary on capacity and vendor deals.
Cyclical and value investors had Boeing on their checklist. Delivery confirmations would be the signal to tilt heavier into industrials. Missed numbers or supplier issues would argue for prudence and a margin of safety. Event and momentum traders, meanwhile, were watching Tesla and the social media headlines for trading opportunities, but also risk.
Credit and distressed investors were getting a reminder to stay sharp. The string of 8K filings, bankruptcies at Fat Brands and Twin Hospitality, exit costs at Pinterest, created pockets of heightened credit risk. Distressed players needed to time claims and value recoveries carefully.
There was also a constructive item for impact and renewable investors buried in the news. The European Investment Bank picked a firm to advise on a tidal project. That kind of selection can de-risk project funding and help raise later rounds, which was a positive signal for marine renewables.
Before we move to concrete actions, let's make sure we explain why GPU capacity is such a binding constraint in simple terms. Imagine a popular new app. Demand is there, but you don't have enough servers to host users. No amount of software wizardry sells subscriptions if the boxes that run the models aren't there. Building those boxes at scale requires chips, servers, racks, cooling, power upgrades, and time.
Exactly. It's a physical supply chain problem. GPU chips are expensive and have long lead times. Integrating them into data centers takes engineering and capital. So this quarter, the revenue story depended on logistics and execution almost as much as product market fit.
So what should investors actually do? We'll give tactical checks. For AI plays, watch Microsoft's disclosed metrics, installed GPU counts, utilization rates, and any supply agreements. If management showed a clear pipeline for deployments, expect a re-rating. If not, downside was possible.
For cyclicals, read Boeing's delivery numbers and the tone on supplier readiness. A beat with conservative production guidance would be preferable to a miss or erratic commentary. For ad economy exposure, treat the social media trial as a multi-month volatility catalyst and consider hedging large positions until outcomes were clearer.
For income investors eyeing UPS, validate dividend sustainability by modeling operating cash flow minus capex and examining one-time items in the quarter. For corporate action and credit risk, scan 8K exhibits for material terms. Those attachments often contain the dollar amounts and contractual details that aren't obvious in summary notices.
Let me add one practical tip for listeners who trade or allocate. Don't let narratives run ahead of evidence. Today reinforce that narratives like AI demand or delivery recovery only move markets sustainably when matched by operational proof, installed capacity, confirmed deliveries, or court outcomes.
Totally. So our bottom line takeaway, selective conviction. Overweight where execution was verifiable, hedge where legal and supply chain uncertainty remained material, and keep a close watch on filings and management commentary during the next several earnings cycles.
Quick recap of the essentials. Microsoft's quarter hinged on GPU capacity and install cadence. Boeing's fourth quarter was a delivery test for cyclical recovery. The social media trial was a headline risk that could affect ad revenues. And a batch of 8K filings amplified idiosyncratic risk in smaller names.
Nice summary. If we had to give 3 concrete actions for listeners right now: 1. Monitor Microsoft's capacity metrics closely. 2. Read Boeing's delivery counts and supplier commentary. And 3. Size or hedge ad tech exposure until legal outcomes were clearer.
And don't forget to keep checking 8K filings for surprise disclosures. They often show up before market moves and can offer an information edge.
That's our show for today. If you have questions about anything we covered, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening, and we'll see you on the next Alpha Recap.